All right. So chapter 12, we're on investments, and y'all have all had financial management, intermediate one. Remember, we've done bonds. Remember how we did bonds as if we were issuing them. Now we're kind of on the other side, but you still calculate everything the same way. It's just now you're the company that bought bonds in another company, so it's an asset to us. We still keep up with it almost the same way, except it's an asset, not a liability. Okay. So we learned how to do those bond issuance on our TI 84 calculators. So that will come in handy for this chapter to be able to use those. Okay. So let's kind of talk about financial instruments. We have equity securities. This is common stock, preferred stock. They're going to talk about categories. Equities do not have a category called held to maturity because they're equity. You know, there's not a time limit on how long you can have your money in a stock. Whereas bonds and notes, there is a held to maturity category because they're going to be 30 years, 20, 30 years. There is going to be an end to them at some point. Okay. So they call that held to maturity, but there will not be a held to maturity on the equity side. Okay. So why are we doing this? We want to make sure we're accounting correctly for the money we are making, the interest revenue we're making, and the dividend revenue we make. Remember, I always said you're never going to see anything called dividend expense, but you would see a dividend revenue. This is when we've bought stock in another company's business. Okay. Make sure we account for those correctly. And we are going to look at market prices when it comes to some of these, whereas there's really nothing else in intermediate that we look at a market price. But this is the one area that pretty much is the same for IFRS and GAAP, mainly because it's really easy to go on the market and find what the market value is of a stock or a bond. Okay. So that's readily available information. So that's one reason I think GAAP is okay with it, because we can find a fair value on it. Okay. All right. Let me make this go away. Go. There we go. All right. So the first thing we're going to do is talk about a debt security. Okay. There is a specified date when it matures. Remember, have a maturity date. We have the principal amount, what is printed on the bond. That is sometimes called the face or the par, something like that. And then interest is paid to the investors. Okay. The principal and interest payments, there are streams of cash flows. Remember that. You've got the face that's due at the very end of the bond, but then you have the string of interest payments. That's the annuity. Remember, we use that annuity table. And then the other one was the present value of just one. Okay. Because just like when we're issuing bonds, the market rate's almost never going to be the same as the stated rate that is printed on the bond. Okay. So I'm going to jump down here. They have us a problem here. So on July 1st, 2027, we have 700,000 face. That is our face. Let me switch back to red. I like red a little better. It pops off the page. I had switched it for something last class. There we go. All right. Things that we need. We need the face, which is 700,000. The stated rate is the 12%. Okay. They're dated July 1st. They're telling us that interest of 42,000 is payable semi-annually on June 30th and December 31st. They didn't have to give us that, y'all. We can calculate that ourselves. And most of the time they won't give it to you, especially on CPA exams. So we might as well calculate it here. So if you take the face, multiply it times the 12%, back up. That's 84,000. It's semi-annual interest. So we are going to divide that in half to get 42. They didn't have to tell us that 42,000. They're probably going to make you calculate it almost every time. Okay. They said the bonds mature in 3 years. I'm going to write that down. I like writing these little things down on the side when I'm working problems just because it helps my ADD. Okay. United Intergroup Inc. purchased the entire bond issue on a date when the market interest rate of bonds of similar risk is 14%. So the market rate is 14%. Well, you can see down here, we already know it's at a discount. We don't have to see that. We can say stated rate's 12%. Everybody else's bonds are paying 14%. Nobody wants our bonds. We have to discount our bonds down. Okay. Nobody wants that one. So it gets discounted down. So it's going to be less than that face. Okay. The way they calculated it, they used the present value tables. Since we did a really good job of learning how to do that in our calculator in the fall in 2 classes, financial management and intermediate, I would say use that. Understand the tables because you might be given that if you're, you won't be able to have your TI-84 calculator to use on the CPA exam. That would be nice, but you will need to know how to use those tables, which I kind of taught y'all all different methods. We spent a long time in financial management, didn't we? We spent a long time on Excel doing it, the tables. Probably the only thing I don't think I did was the formulas, which is kind of beyond what we want to do when it comes to that. We don't want to do the formulas, okay? So we're calculating the bond the exact same way. They found the factors. We had this string of cash flows, the interest, that's an annuity. Annuity gets paid every 6 months. And so they found the factor. They found the factor where N equals 6 and I is 7%. They got the 6 from 3 years multiplied times 2 to payment entries every year. And then the interest rate was the market rate divided in 2 to get the 7%. Oops. Come back. Okay. To get that 7% interest. So that's where they got those factors off of the present value tables. Okay. All right. So we did that one. I think they're going to make us do the journal entry. That would be nice if they did. Let's do it anyway. I just figured this out the other day, how to put some space in between these slides. Look at that. Isn't that cool? So we would debit investments of that face. Because remember, if we were on the other side of it, we always put the face in the bonds payable. We're on the asset side now. Okay. Cash, we're paying for this investment. So cash of that 60, those too many sixes there. And then the difference between those two, which I did not get. Let me get that really quick. Is 33,376. And I can't remember exactly what they call that. That's why I thought they had that journal entry here. Oh, there it is. Discount on bond investment. Okay. But those accounts work together just like they did on the liability side. They're just on the asset side now. And we are the business earning revenue, not necessarily paying expenses. Okay. So I'm going to jump back up here. Y'all should know that this, because we've done it quite a bit now. When the interest rate is higher than the market rate, that is always a premium. When the interest rate, the stated rate is lower than the market rate, then it is a discount. That was the previous example. And remember, that's always expressed as like a percentage. So like if market rate and stated rate are the same, they would issue those at 100. They don't put a percent sign. It's just an understood percent sign. So a premium would be, let's just say 102. That's 102%. Put it in your calculator, 1.02. If it's a discount, anything less than 100. So it could be 98. They don't put that percent sign. Just know that's you've got to adjust for that. Okay. So, what are some key events in the life of a debt investment? Purchasing the investment, okay, receiving the periodic interest payments, holding the bonds during periods in which fair value changes, incurring some unrealized holding gains and losses. This does happen because this is one of those areas here in GAAP we can look at fair value. Okay, and we can get a good fair value number so we can actually write it up depending on what we are going to do with that bond. Okay, it does depend on what is our goal. Are we going to hold it till maturity? That's a category. Some of these are going to be called, they're going to call them trading securities. Trading, if you think about trading, that's going to be like a day trader who's buying and selling every single day. They're looking for the dips and peaks in stocks and bonds every day, every minute of the day. That's what their business is. So that'll be categorized just a little bit different as well. Okay. Selling the bonds before maturity or receiving principal at maturity. The place I worked in college where they had a lot of investments, millions of dollars in different investments. They had like some brick and mortar businesses, but they also had several investments, and they had lots of bonds, and almost every single month, because bonds will have a callable feature on them, there'd be a business that called the bonds. And really why they do that is to get the interest lowered. So they'll call the bonds, they'll have a call feature, they'll call them, reissue them, different things like that. But as the investor side, if they call the bonds, you get your cash for it, but then you got to find another investment to put that money in. Okay. That's where your person who handles, like, JP Morgan, those places handle things like that. Okay. Not necessarily your normal bank. There might be, you might have, some characteristics like if a bond gets called, find us something else to put it in that's similar risk, similar interest. Okay. And all that risk and reward goes into that computation as well. Okay. All right. So there we made the journal entry for those. These two accounts, they're married till death do them part. Okay. That discount is going to get amortized out just like we did on the liability side. And at the end of this bond's life, it will have a book value of the 700,000. Okay. I'm going to skip that. Okay. So here we're going to make the journal entry to record the first interest payment. Okay. So we already know $42,000 of cash is going to be paid. I'm sorry, we're going to receive it. I'm getting confused too because it's on the liability side. We pay it, but we're getting the 42,000. Remember, that's what's on the bond. The face times the stated rate. That is what they legally have to pay because that is what is on the bond. Okay. But there's really more interest revenue here because that extra from 700,000 to the 666,000, that's going to be extra interest revenue. Okay. So we've got to amortize that out. So they took the book value at that point, multiplied it times the 14%, and then divided by 2. I'm going to do it in the calculator just so you can kind of say, oh, look, I've already got 42,000 in there. So if we take the face of it, multiply that times 1.14, we get that number, but that's not our number because we're only doing a half a year. So if we divide that by 2, there we get the 46.6, and it looks like they just dropped the 31 cents. Okay. All right. So that's how much interest we are taking that interest on bond investment. We took, this is our interest, and we subtracted the 42,000 from it to get the difference between there. We're going to amortize 46.64 of that discount. So I like to come over here and draw these T accounts out. That discount on investment was, what was it? 33,367. okay? We are debiting that extra amount to this account because we're trying to get it to go away. Remember, our goal is to make that go towards zero. We're always going towards the face. So if they held that to maturity, they're going to get $700,000 even, okay? So what does that discount represent for us? It represents extra interest we're going to get, okay? Even though we're only getting the cash based on the 12%, we are going to get that cash later on, okay? Sometimes drawing those T accounts actually helps you figure out if it's a debit or credit that you need. But in this case, you can figure cash out, you can figure out the interest revenue back into it, what you need. Here is the amortization table, and you can see this discount balance right here, it's going towards zero, okay? The book value going towards the face. It doesn't matter if it's a premium or a discount, it's going to always be going for the face. So if it was a premium, it'd be going down to get to the face. Here, it's a discount. It is going up to get to the face. Okay. All right. Now, how are we going to classify some of these? Okay. So the fair value of bonds will change as the market interest rates change, resulting in unrealized holding gains and losses. Unrealized, okay? Because we're not selling it, that would be realized, okay? So unrealized holding losses, they happen when the market interest rises after a bond is purchased, and a holding gain would happen when the market interest falls after the bond is purchased, okay? So now we're going to go through these different categories. I've kind of already hinted at a couple of them, okay, on how we're going to account for them. The one we just went through, it looks like it's probably going to be held to maturity, especially since it's only 3 years. They call that amortized cost. That's what we've been doing this whole time. We've been doing amortized cost the entire time, okay? So don't let that terminology shake your confidence, because that's what we've been doing, okay? So there is nothing that's going to be an unrealized holding gains or losses, because we have the ability, they have to have the ability to hold it till maturity and the intent to hold it to maturity. So there is no unrealized holding gains or losses. We're going to account for any gains or losses at the end of that term, okay? So we're not going to do anything in the interim. When it is a trading securities, this is what I just mentioned a minute ago, where day traders, they're looking at those dips and peaks going up and down throughout just a day's period. That's what they do all the time, okay? That's what they're in the business of doing. They're day traders, okay? They're in the business of doing that. So any unrealized holding gains or losses goes to retained earnings as part of shareholders' equity. Okay, it's recognized in net income, so you will see it on the income statement. Okay, this is a big departure from anything else we've done in GAAP, but it is almost identical. I think all 4 of y'all are in international accounting right now, so this is a really good, really good lesson. This is the one area where it is completely converged with IFRS. Okay. Then we could have them available for sale, okay? It doesn't qualify as a held to maturity or trading, then it's going to be called available for sale. Any unrealized holding gains or losses is going to be in OCI. We've talked about that quite a bit, that other comprehensive income. That it's that little extra past the income statement. Sometimes it's on a different page. Sometimes it just is a little extension of the income statement, okay? Both of these, trading and available for sale, are going to be carried. We're going to recognize that, and they will be on our books at fair value, okay? And I think that is all for the first objective. Here they give us just a little note from the UPS, summary on accounting policies and marketable securities. They're just telling us how they account for them. Remember, there's lots of notes to all of these financial statements. Only 4 pages of numbers, but 1,000 pages of notes. Okay, that's all for objective 1. So we will stop there and pick up on the next one.